Chapter 10, Part 3, we're going to look at capitalized interest for construction projects. Now, capitalized costs include all costs associated with getting the tangible asset ready for its intended purpose. This also would include interest. So, a company might decide to construct an asset for its own use rather than buy an existing one, and identifying the cost is difficult because there's no external transaction to establish an exchange price. So, determining the amount of indirect manufacturing costs overhead to be allocated to the construction price, and deciding on the proper treatment of interest if money has to be borrowed, actual or implied, incurred during construction. Our focus is on capitalizing the interest. We're not worried about the overhead. That's covered in managerial accounting. Okay, overhead allocation. We have the main thing we're concerned with is interest capitalization. Okay? So, what amount of interest do we capitalize? That's the question. There are three approaches that are used. We have the capitalized no interest, now that's not good, capitalize actual interest with modification, that's what GAAP requires, and capitalize all interest during the period, that is not acceptable. Right? So let's go through the rules on how you determine how much interest to capitalize. Capitalization period. It begins when expenditures are made and interest is being incurred, and ends when project complete and ready for use. The amount of interest is the difference. It's either the actual interest or the avoidable interest, whichever is less. So now let's take a look at an example. On December 31st, Maine Inc. borrowed $1 million at 12% payable annually to finance the construction of a new building. The company made the following expenditures related to this building. We made spent $360 on March, $600,000 June 1st, July 1st 1.5, and on December 1st 1.5. The building was completed in February 2022, and now we're looking at how much interest do we need to capitalize in 2021 when also we had two other debts outstanding, a 10-year 11% bond and a 6-year 10% note. So what information do we need? We need to know that $1 million was borrowed specifically for the construction of the new building, which means that we're going to include all that interest. Then what we have to do is figure out the weighted average of these payments. And that's what we're going to do first, is determine the weighted average as the accumulated expenditures for the building in 2021. So the way we do that is we take the month, the amount, times the number of months left in the year. So if it's March 1st, we've got 10 months, and we're going to take that and divide by 12. Then June 1st, we have $600,000 for 7/12. We have July 1st, we've got a half a year of 1.5. And on December 1st, we've got, for 1 month, 1.5 million, which give us a weighted average accumulated expenditures of 2021. Now, if you get a problem that says the expenditures were done evenly through the year, then you just divide it by 2 to get an average. But in this case, we were made through the year, so we have to do a weighted average. So this is the number we need to figure out the interest that would apply to that amount of expenditures. So this is what we do next. Step 2. We're going to determine the total interest. So we have first, we have the construction loan, which was $1 million times 12%. Then we've got the other loan costs, which is $600,000. Which tells us our total interest for the year for 2020, that should be, wait, just wait a second. Okay, I had to change that date. So the actual total interest for 2021 is $720. Now we have to determine the weighted average interest rate for non-construction loans. And what we're going to do there is we're going to take the $600,000, which is the interest associated with the non-construction loans, divided by the total non-construction loans, which gives us an average rate of 10.71. Now we're going to determine the avoidable interest. So to do that, we're going to take our weighted expenditures, subtract out the construction loan, which was at 12%, and the balance is going to be taken by that weighted interest rate, which tells us avoidable interest, if we had not worked on this project, was $176,228. Now we're going to capitalize whichever is lower. So in this case, the lower amount is the avoidable interest, so that's the amount we're going to journal entry. And this is our journal. So that's how you determine how much interest to capitalize on a project that you're constructing.